Welcome on board, Morgan Housel, partner collaborative fund, joining in the show right now. Morgan, hi, morning. Good to have you on the show. We've been discussing time and again as to how global markets are at record highs and continue to show this kind of incessant strength. They clearly have priced in the trade deal and continue to move higher. Are investors, though, getting ahead of themselves? Or would you say that this move is very much on expected lines, anticipated lines?
I think it's really interesting if you look at the last decade. Let's back up from the last year of the trade war and just look at the last decade, where the market has done incredibly well. But there's been a lot of bad news in the last decade. If you go back 10 years ago, we started with the greatest recession in 80 years, and we had 10% unemployment in the United States. And then we had our federal government shut down, and we had our debt downgraded, and we had all of our issues with politics in the United States. And the market has kept going up and up and up. And I think the trade war really fits into that same pattern of a market that is not necessarily ignoring what most people would think is bad news, but there have just been a lot of other factors that have been pushing the market higher that supersede what other people would think is bad news, like the trade war. And so earnings in the United States and across the globe have been enough to push it up. But we also have this environment where interest rates are so low that even if the deals that you're getting in the stock market are not that attractive, they're much more attractive than what you can get in the bond market and in cash. And then we have this other factor, which is just changes in how people invest, and the changes of how they invest in the last 20 years have been moving away from active management towards passive products. And in a passive product, you are not making a bet on whether you think we're going to have a recession this year or when the trade war is going to be resolved. You're just investing out of your paycheck every other week, come hell or high water, and I think that is a big force in the stock market that keeps it moving higher in a way that is less attached to day-to-day news than it used to be. And I think the trade war really fits that pattern.
Where would you invest at a time like this? What about commodities? Do you think we've seen a major rise in oil and oil stocks globally, similar to what we saw late cycle in 2007, 2008?
I think, from a more macro perspective and a sector perspective, I'm really concerned at taking a much longer view and saying what would be the best regions to invest in, not over the next year, the next 10 years, but even the next generation. And one of the big trends that I look at right now, and this does fit into an oil argument as well, is just demographics across the world. And you have a lot of large economies like China and Russia and most of Europe whose demographics are very poor. And their working age populations are either already declining or very soon about to start declining. That is not true in the United States, where our working age population is now growing again for one of the first times in a decade. It's not true, of course, in India, and it's not true in parts of Africa as well. So I think if you look at the next generation, there's going to be a lot of countries from a macro perspective that face a lot of big headwinds, very similar to the headwind that Japan has faced in the last 20 or 30 years with demographics. In terms of something like oil, I think, if we were to look at the demographic issue of what is facing most of the world, I think we're likely going to have lower growth over the next generation than we did in the past generation, just because populations around the world are growing much slower than they did for most of the 20th century. And to the extent that that would have an impact on something like oil demand, I think that's a very valid argument. And to say that oil is probably going to have less pressure on the demand side, to leave the supply side aside, than it did for most of the last 30 years is, I think, a very valid argument.
So with inflation coming back, the fact that in the last 10 years, commodities have been flat from oil to gold to copper to cocoa. If inflation comes back, what would you be looking at investing?
That's something that we've been looking at and discussing and expecting for more than a decade. It really began in 2008 when our Federal Reserve, our central bank, was printing a lot of money after the financial crisis. And of course, we have seen inflation, let's say, in asset prices, in the stock market, in some places in real estate and in bonds and whatnot. But price inflation outside of a few small groups like healthcare and education has been very tame in the United States and across most of the developed world. And when you're trying to make a prediction about when that's going to change, I think we have to look at the last decade and say everyone expected it to come already. Most people expected it to come already, and it did not. So what are we getting wrong about our forecasting models, about our ability to predict? And that when we're looking forward, we have to say, look, we've expected this and it didn't happen. So what are we missing in our forecasting models? And to go back to an issue with demographics, I think we would say, is, we have much lower economic growth kind of as our baseline rate because of demographics than we used to, than was the case for most of the 20th century. That is going to make sparking inflation across most of the world, just from a demand side, much more difficult than it used to be. So I'm probably more subdued on inflation than I would have been for most of the last decade, just because some of the macro forces that are playing a big role that has kept inflation low for the last decade, I think are probably going to stick around for most of the next generation. That's not to say that we can't have inflation, or we can't have a big spike in inflation. And it's definitely not to say that there aren't going to be times when certain commodities and certain sectors, whether that's oil or education or healthcare, are going to experience a lot of inflation within their own sectors. But I'm probably more tame on inflation overall than I've been at any point in my life that I've been thinking about this topic.
Morgan, you touched upon the overall macro outlook. So let's talk about India and what's happening here. Given all the worries that we've had about the slowdown, the economy, we're counting down towards the budget. I know that's very near term, but where does India fit into the overall picture?
If I'm thinking about India from a macro point of view and a long-term point of view, I actually think India today looks very similar to where the United States was maybe 100 years ago, in terms of a country that has so much dynamism and so much potential, so much opportunity, so much entrepreneurship, a growing population. Things that I think we miss in the United States now that we used to have that maybe don't apply to us that much anymore. And so what was true about the United States 100 years ago, and then I think is true for India today, is that growth over the next generation is going to be extraordinary. But during that path of growth, there's of course going to be a lot of ups and downs that are a natural part of that growth. During the United States, most prosperous growth periods, if you go back to the 20th and 19th century, were filled with enormous recessions, enormous problems, big hiccups, big headaches, big market crashes. But if you look at the long history of it, the factors that we had that were leading to that growth in terms of dynamism and population growth and entrepreneurism really pushed growth in a very extreme way. And that's kind of the same bucket that I would put India in. So not necessarily forecasting what's going to happen in India this year or next, but just looking at a macro perspective, what factors does India have going for it that's going to make a big difference in the next decade? And I think it has a lot, or in the next generation, I would say. And I think it has a lot of factors going for it that would make me very optimistic on India for the next generation.
Okay. Morgan, for the sake of argument here, the likes of Milton Berg have been saying that it's absolutely possible to time the market. Would you agree? And what's the best way for investors to approach things currently?
I think, is it possible? Sure. There are a lot of very smart people out there. And there are a lot of systems that I think make a lot of sense that might be able to time the market, time ups and downs. So, but even if it's possible, I just don't think it's necessary, and I don't think it's particularly useful. To the extent that it's possible, it's not a slam dunk 100% certainty that people can do it. So what you have to size up is, even if you think that it's possible that you can do it, what is the risk that as you're trying to do it, you're going to screw something up or get something wrong in a way that's going to leave you with much lower returns than if you had just endured the market's volatility over a long period of time. So I think for the vast majority of investors, rather than saying, what is the theory, the system, the tactics that I can use to get around ups and downs, I think it's just much more useful for professional and individual investors alike to just say, what can I do to my allocation and my mindset, my psychology, to just make it easier for me to endure the market's ups and downs? Because that is something that I think has a much higher probability of working than any of the tactics that I've seen that people use to try to time the market's ups and downs.
Right. Morgan, you've always said that the biggest risk is what people are not talking about. And this day and age of information overload, what do you concur is the biggest risk? What are people not talking about?
I think the biggest risk for the global market at all times is, just like you said, it's what people are not talking about. But to give something more concrete, I think what's going on with a lot of politics in the developed world and spreading to other parts of the region in terms of nationalistic tendencies, in terms of extreme right-wing tendencies in the United States, that has led to Donald Trump in the United States, kind of Brexit in the UK, is leading us down to a path that I think we don't know where it's going to head. And if history is any guide, it can lead to times that are both economically and culturally very difficult for lots of groups. So it's a difficult topic to discuss because a lot of people feel very passionately on one side or the other. But I think anytime you're just going down a very different path than we have been on for most of modern history, where most people's their models of how the economy works are different from where we're going now in terms of politics across the world, it adds a risk in terms of we just don't really know what's going to happen next with new tax laws, immigration laws, corporate rules, and whatnot. And then on a different side, what protests and different just kind of psychological factors are going to start hitting economies around the world. So I would say that is, in terms of the known risks, not the unknown risks that are always the most dangerous. In terms of what we know and is out there right now, I would say politics, particularly in the developed world, is probably the biggest risk.
Right. But Morgan, with these kind of record highs, both in terms of prices as well as valuation, do you really see the law of diminishing returns kicking in?
Well, certainly at the individual stock level, no matter where the market is, whether we're in the middle of a huge bull market or during a big bear market, there's always going to be individual companies that are performing very well, both at the company level and the stock market level. That's always going to be the case. If you look at the market as a whole, though, I think it is a good first rule to think that in the future we're going to have lower returns than we did in the past, just because of where valuations are today. But that does not mean that the market is going to go down over the next year or it's going to be flat over the next 10 years. Just if you're going to say that you think it's a good chance that market returns will be lower over a long period of time, does not mean that we can't go much higher than we are today. And that has been a good lesson for the last decade, when even if you went back 10 years, the rules and the comments about new normal, lower returns going forward, were made by very smart people 10 years ago, and the market has more than doubled during that period of time. So I think it's a good thing to think about and to prepare your expectations. I just don't know if having different expectations would necessarily change how you invest, particularly if you're thinking about betting against the stock market or shorting stocks. That I think gets very dangerous.
So from all your laws of investing, which are the principles that have held you in good study and seated in recent times?
I think one of the most meaningful and the most important from the last decade. And I'm saying all this in the context of U.S. stocks are at new all-time highs and they keep going higher almost every day, surprising everyone. I think a good principle to keep in mind during this period is humility. The fact that if you go back 5, 10, even 1 year ago, very few people, smart people with a lot of experience, predicted that we would be where we are today. And I think the lesson from that is just humility. If we have not been able to predict what happened over the last decade with any sort of precision, we shouldn't pretend like we can predict the next 5 or 10 or even year with any sort of precision as well. So I think just having a lot of humility in our market forecast has probably been the biggest lesson of the last decade and is one of the most useful principles to keep in mind today.
All right, Morgan, really appreciate your time. Thank you for joining us. Always look forward to our interactions. I mean, the amount of depth and the way you really talk about investing behavior and the fact that risk, the importance of risk is so underrated in today's